Hi everyone, can you hear me?
Yes, yes.
Perfect, perfect. Hi everyone, and welcome to today's webinar on how Foundries drive growth by fixing credit risk. Right, I am Gaurav. I am your host for this session, and we all know how important production is in a foundry, right? But what we often unnotice is that how much of an impact finance has on growth. Things like delayed payment and risky buyers and blocked working capital can quietly slow things down, right? To help us understand this and how to tackle these challenges, I'm excited to welcome Pratik Rosalka, our Vice President Finance at Now Purchase. Pratik is a chartered accountant with over 10 years of experience across industries like media, consulting, and B2B marketplaces. At Now Purchase, he leads our finance function and works closely with foundries to help them grow sustainably and profitably, right? Over to you, Pratik.
Thank you so much, Gaurav. Hi, everyone. Welcome to today's session. Really excited to have all of you here. The topic today is something we all feel but don't talk about enough. How credit risk and working capital issues silently slows us down, right? As foundry owners, or you can assume any manufacturers, we often think growth means adding more machines, investing more on the plants, and new products, right? Development of new products. But what if I told you that the real growth unlock is simply making your money move faster, smarter cash flow, better buyer discipline, and capital that works as hard as you do? This webinar is here to help you understand just how crucial your finance strategy is. It's every bit is as important as your production. So let's get started. Today I'll be discussing about a few things which is here in the agenda. So we'll be discussing about, what are the costs we are incurring by doing nothing? Finance, how finance can help that smarter growth start with better habits. The shift most haven't made, what we are going to do exactly in this webinar. What's next for you and the journey ahead. So what is the cost of doing nothing? We often realize that there is a lot of capital is stuck in the working capital. Example, when we speak of our AR cycles is mostly say 30 to 60 days. If we can reduce that cycle by half, say example, your AR cycle is 60 days and we are reducing it to 30 days, you can almost double your revenue, right? So I'll give you a short example here. Suppose your AR cycle is 60 days, right? Your sales is say 100 lakhs. Now assume that your air cycle gets reduced to 30 days. Your this 100 rupees comes 30 days faster, which means you can rotate that money again and make sure that that 100 is doubled. So your turnover automatically gets doubled to 200 crore, right? If you are earning say 5 crore profit in this particular 100 crore turnover, now you'll be earning approximately 10 crore profits without infusing any kind of additional cash in the working capital. So that's the magic of controlling your working capital. We'll come back to the presentation again. Moreover, when we do normal sales, we usually don't check the debtor diligence, right? So basically, what happens is like if you are working with 10 debtors and your debtors, one debtor becomes bad, right? You incur some kind of bad debts. Ultimately, so, in the last year, we make 100 crores of sales. Again, coming back to our example, we make 100 crores of sales. In this 100 crore, even if we have, say, 2 crore of bad debt, now from our profit of 5 crore, 2 crore goes away. So we automatically reduce ourselves to 3 crore. Now this reduction of 2 crore from profits, it's actually, nothing when we see from the turnover perspective. Say, out of 100 crore, only 2 crore became bad debt. But ultimately it is eating up my 40% of my turnover, 40% of my PAT profits, right? So which is very dangerous. And we usually, in our normal parlance in India, we don't check our debtors. So it is very important that, we also exercise proper due diligence while we are entering into any kind of transactions. Now, how can finance help you, in those kind of problems which we heard in the last slide? Optimizing your working capital, ensuring that, you are reducing your AR days, increasing your AP days, reducing your inventory days. Those can reduce your working capital, and henceforth you can have extra cash in your working capital without any investment. You can scale. So having external capital available, is always like, you having 5 crore of limit. Now, in case you also have a 5 crore extra limit, it will always help you take any extra orders, which can happen any kind of, any kind of surprises can happen. Some big manufacturer can give you a order of, say, 50 crores and you don't have extra capital. So it is always better to have a bucket for extra capital. So it is just proper management of finance, right? And then what we spoke of, how to protect ourselves from bad debtors. How do we do that? So, when I say optimize working capital cycle, what we can do is we reduce our AR days. We can get into lot of discounting. Example, today there are trades platform which are discounting invoices for MSMEs, right? So, your normal payment terms was approximately 60 days from the date of sale. Now, when we discount it through trades platforms, we will get that money within 7 to 8 days. So what your money should have come after 60 days, now it is coming within a week. So actually you are again using that money to make sure that you can double up or triple up your sales, right? So this is how the working capital cycle is optimized. Now, like I spoke of demand-based funds, example, you keeping some extra flexible loans with you for the surprise orders, right? And then comes credit report. We when we enter into suppose your sales team comes up with 10 new parties whom they want to deal with. Now you don't know the history of how those parties are, right? We will enter into, say, do all the paper checks, make sure that the customer is checked from the basis of legal checks, on the basis of the numbers, on the basis of their compliances, their GST's filings are okay or not, their PF filings are okay or not. And then we make sure that the customer is good. The shift that most haven't made, actually, how we used to deal in older days and how we will do how we will deal with now, right? So in older days we used to wait for the payments. We have made a sale of, say, 100 crore. Now we will wait for, say, 60 days. Even if that customer is dealing the payment, we will still be okay and we will be following up, right? But new ways basically to ensure your collection team is always there to collect the payments. make sure that the reminders are set properly within before the due dates, so that the customer is pretty much knowing that we need to pay. We used to accept all the buyers. Whenever our sales team used to come up with 10 different customers they want to onboard, we would have given full liberty to them to onboard those customers. But now what we will do is, like, we will do the credit check. We will make sure that the debtor quality is good, so that in future you don't end up having bad debts at all. Just giving you an example, we have helped a lot of foundries in our own company. In the last few years we have done revenue worth of 600 650 crores, and surprisingly there was no bad debts. So that has happened only because we have been able to control it through our stringent credit checks, right? Now we used to chase overdue bills, like I explained. Now when we know that what kind of customers have what kind of profile, we would also work with some risky customers, so we will know whom to follow early, right? We used to borrow the funds when we have gotten some excess orders. Now we are in a position that we will plan for it, because we know that our working capital is working this way and we may need 5 crore additional fund. So we will always keep that extra book in hand, a banker ready, financier ready, who will make sure that when you get any extra orders, we'll have that kind of capital and you don't have to take the headache. So how we will actually understand if our financial strategies are okay or not, right? We need to ask certain simple questions to us. Do we have a balanced working capital? Do you know how is your collection health? Say, how is your collection team working? What kind of AR days are there? What kind of profiles are there for the debtors? Say, there are three debtors with us. One is having 30 days, one is having 60 days, one is having 90 days. So, these kind of calculations can be done on an advanced basis, right? Are your buyers credit worthy? Again, like we spoke of credit check. How can financing play a role in increasing your profits? There are a lot of supply chain financing, which has come up in the modern financing era. How we can integrate that? Are your vendors 100% GST and IT compliant? So we also face a lot of input tax credit issue when we are dealing with a lot of vendors who are non-compliant, right? So in this particular credit check, we also make sure that we are dealing with proper vendors who are having correct warehouses, who are not having any kind of compliance issues, who are not having any kind of GST return filing issues, and henceforth we are ensured that whenever we get any GST scrutiny case, we are not at a bad position, right? So fixing cash flow is cheaper than funding delays and chasing defaults, obviously. What we need to do is analyze the questions which I asked. Basically, how your financial strategy is working, how is your working capital cycles, how is your receivable cycles. And the next step is basically to act before those issues become very big, right? And so, how do we position ourselves? We at NP Finance right now, we are also doing credit reports. Our credit experts make reports which make sure that our customers are dealing with correct parties, right? They are dealing with correct vendors. So we help people, help partners with all the credit reports. We also help with a lot of financing things. So example, you have a limited loan of 5 crore. Now you want to do a turnover of, say, you want to double your turnover, but your banker is not ready to give you limit because of, you are highly leveraged on debt. So we also help people get loans, or rather, not loans, rather, getting up some supply chain financing. We can get some vendor financing limits. We can get some invoice discounting limits, which is basically not on your books, which will also save you from debt leverages and make sure that your rotation of cash is happening faster, and henceforth it is contributing to your profitability. So this was it, Gaurav.
Thank you. Thank you, Pratik, for this wonderful session. I hope the audience has a lot to think about over this. We will now open the floor for questions. People with questions can either raise their hands or type their questions in the chat, and we will take them up one by one. Pratik, we have one question from Shresht. The question is the financing option just for export or is it available for domestic as well?
Sure, sure. Hi, Shresh. So, financing options is basically available for all kind of sales, whether it is a domestic sale or a international sale. I'll give you just some examples of domestic financing which we help in getting, right? I'll take example of one of our founders which we recently helped. They were facing a problem wherein they were doing sales of approximately 30 crores, right? The problem which they were facing is they had a limited loan of 3 crore from a banker. Now they were wanting to have additional 2 to 3 crores of loan, but which they were not getting because their books was not that kind of heavy, right? Now what we did was we brought up some supply chain financing options from our different partners, who mainly charge them 13-14% interest. But what they made sure is when they are getting some invoices from their customers, so they are generating invoices to their customers, they have discounted those invoices. So they were supposed to get the payment after 60 days. Now they made sure that the payment are getting in, say, 6 to 7 days. So you are again getting that finance to rotate into the further sale, right? So this way you have gotten some extra capital, and this can go far much beyond whatever you require as a finance. So to answer your question simply, we also help with domestic financing. So, it is not just factoring services. Factoring services is one part of the invoice discounting. In India, we have factoring license only with few people, Invoice Mart, RXIL. So those are basically given to MSMEs. If you are a MSME, you can very well discount your invoices, right? But we have a lot of other partners. So basically, your options are not limited. We will analyze your books. We will make sure that you have gotten some kind of financing. So it's like options are unlimited, and the charges are very bare minimal. And in fact, we don't charge anything out of it. Like we in middle don't charge anything out of it. We will make sure that the partner, you as a customer, are getting the financing from the partners. There's no charge, professional charge from our end. To clarify. On the percentage level, so if you are working with a very big client, say example, Shrey's question is basically, how much is the percentage cost if we are discounting, right? Through a party like say L&T. So L&T being a very big company, what happens is like when you go through a trades platform, they will give the discounting basis L&T's net worth, right? Now what happens? So, to keep it precise, the discounting rate will be 7 to 8% because they are AAA rated. Now, the ones who are very highly rated by rating agencies, in the trades platform, you will get very lesser discounting rate, close to 7 to 9%, which is like bare minimum, which even a bank OD or CC rates is, higher than that rate, right? So you can go with 7 to 8% rate if you are, using L&T as your customer. It is completely on the, so if there is a payment default at the end of the customer, it is completely on them because trades is ultimately taking the recourse on that particular client, which is L&T, and because they are AAA rated, so usually trades gives limits only to very high over the businesses like L&T you mentioned.
Pratik, we have a question from Paresh as well. How can bill discounting on threads? We are registered on RXL but not able to do the discounting because our buyers are not supporting.
Sure. So, Paresh, what happens? Buyers usually, are not willing to discount because they don't understand the value of it, right? So, you have to first of all make sure that the buyer is completely aware of, what your need is. What in this also we can help speaking to your buyer and make them understand why is it beneficial to them as well as you. Obviously, sometimes buyers only take it from the perspective that my vendor is getting the benefit, I'm not getting any kind of benefit, right? So henceforth buyers are always like, no, we will not discount. But there are a lot of other options, like you offer to buyer that let's say we will share the interest cost, or say I'll bear the interest cost. What, there is no loss to your business, right? So those kind of conversations can be initiated to make sure that the buyer is onboarded. But we usually face this kind of issue always when we are onboarding certain customers on trends. And it is completely okay. It is just a matter of negotiation, and we will completely help you, getting those customers of yours onboarded on trades, and speaking to them regarding discounting of your invoices. Any further questions? So I'll take first question from Paresh. We are a MSME. If buyer not giving payment within 45 days, what option we are having to get payment on time? So as a MSME, we obviously get option to go to MSME website and raise a complaint that we are not getting the payment within 45 days, which is as per the rule of MSME, right? But usually we don't want to take that to that particular level, because we also want to maintain relationship with our buyer, right? Henceforth we always not go ahead with filing the case, or filing application in MSME. But usually through trades now people are more aware about that MSME can get the payment within 45 days, and whatever credit period me as a customer would require, I am getting through trades, right? So this is how trades is also helping in resolving the MSME 45 days limit. I'll take Shay's question. Who's doing the underwriting? Are you using only trades or other platforms too? So we using almost all platforms. The underwriting is usually when we are getting onboarded, or onboarding our customer into trades. It is trades who is doing the underwriting. So underwriting is very simple. That if your customer is rated triple B minus and above, the trades platforms, any platform like four platforms, are ready to onboard that client. Henceforth, the rating works a lot. Then there are other. So if buyer is a very small company, so Shrey's question is just for everyone's knowledge. Shrey's question is, you are dealing with a smaller customer and not a rated customer through some rating agency. What happens then? So then we also have other financing options. There are a lot of partners as of today who are helping those customers invoices getting discounted. One of our partners today, who is also doing panel discussion from Tap Invest, Tap Capital. They are one of our partners who are helping smaller customers and vendors getting onboarded into their platform and getting those invoices discounted. So there are a lot of platforms available, and we can assist you getting onboarded in those platforms. Yeah, Gaurav.
We'll wait for two more questions, and then at 12 we will move to the next session. Perfect. I think we are good to go, Prateek. Thank you everyone for sharing your questions. I hope this was insightful, and thank you, Prateek, for taking up this session. I think like a lot of people will take back a lot of clarity in terms of how financing can help their business further and how they can mitigate the credit risk process. Right. As next step, we now move into the next part of today's session, a panel discussion on how traditional businesses are adopting modern financing. Right, we are joined by four fantastic panelists who brings years of experience in credit lending and fintech. This session will be again moderated by Prateek, and we are looking forward for an engaging conversations on how modern financing is changing the game for manufacturing businesses. Right, over to you, Prateek.
Thank you, Gaurav. Good afternoon, everyone. So, today's discussion is empowering growth, how traditional businesses are adopting modern financing. At Now Purchase, we have seen firsthand how financing and credit related decisions affect a company's ability to grow. I am joined by four industry leaders who will help us explore this further. Amit Rajit from HSBC, MBA Gurga alum with 15 plus years of experience across SBI, ICICI, and Yes Bank. Deep expertise in credit risk plus lending across 1,000 to 5,000 crore portfolios. We have Jayesh from Tata Capital, MBA alumni from Narsi Munji, driving strategic industrial tie-ups across North and East India. We have Matthew from TAP Capital, ex-investment banker, now leading fintech initiatives in SME credit, specializes in supply chain financing and working capital design. We have Piyush from Ease My Risk, finance advisor with 10 plus years in CFO services, tax and strategy compliance, bridging finance and execution for growth stage businesses. So yeah, let's get started. So let's begin by understanding how things were done earlier, like, old versus new. I will first, ask this question to Amitrajit and Jayesh. How did traditional companies usually manage financing and debt? Many still follow the same path. Like, we often know that, a lot of people are only using CC, OD, and all, traditional modes of financing. So why has this continued for so long? Yeah, Amitabh, you can go first.
Yeah, yeah. Thanks, Prateek. And first of all, thanks on a wonderful presentation. I think it is very beneficial and a need of the hour for all companies like SMEs. Because typically what we have seen is the SMEs, once they start, they will focus on the sales, on the incremental business, on how to grow the business. But the basic idea of working capital management and how to make it more efficient, that is something which always takes a backseat initially. But as you have rightly put, if both work in tandem, that's how the real exponential sales and growth we can see in the long run. Uh, if we talk about how traditionally business were done and how things are changing now, the basic difference is on the usage of financial products. Uh, OD, overdraft, CC, cash credit, these were the common facilities being offered by banks also earlier, and which the clients were also using, primarily backed by the ease of use. But as time has evolved, what we have seen is these products are very big in nature, uh, both from a bank point of view and the client point of view also. There are instances when the team becomes very if there is a certain amount of limits already available in the form of OD and CC, the tracking reconciliation of the financing becomes difficult for the company in the long run because it's a very pure vanilla product. And from the bank point of view, governance also becomes an issue because we can't exactly determine the end use of these funding. That is when these has been replaced by new age products like bill discounting, both on the purchase and sell side, and structured receivable financing like factoring, forfeiting, and others. Again, these products have a double whammy effect. From the bank point of view, from the financial institution point of view, these are very secure with a proper end use backed by an underlying document and self-liquidating in nature. which gives a lot of comfort for the banks to take uh, greater calls, be it lower security, be it higher in terms of the value. And on the client side also, it's a very like a product which is very easy to reconcile, very easy to track. That if I have taken a 10 cr of loan, I exactly know when it is falling due and how it will be repaid, and how many cycles I will see in the year. So I think these are the products which has really helped evolve both the bank and the entire ecosystem per se.
Great, great, great. Jayesh, what's your say on that?
Yeah, hi, Pradeep. Thanks, first of all, for calling me here and going through your presentation and everything. I guess is the right thing you're doing right now. And the one point which you mentioned before that not just blindly following sales, but doing credit worthiness before giving credit and the bad debt things is, I guess, we must in today's world. Coming back to your question, because I would like to add one thing to that as well. You can also leverage banks' credit worthiness and the credit team by collaborating with bank into other financial products, in which you might be limited to some of the knowledge of the person, but we will be better to judge. So once you enter into even a small contract, we give you better.
Hi, Jay, sorry to cut you off. I think we are facing some voice issue from your side. There's some disturbance coming
Am
in.
I audible now?
Yeah, this is way better now. If
Okay,
you can
okay.
just restart the entire thing, that would be really helpful.
Okay. So starting it again. So I was just adding to what Prateek summed up in his presentation, which went for like last half an hour. So coming to two pointers, which the current question, that shift from traditional to modern, and one the businesses are not governed by just the business part, but also the credit worthiness of that person. So I was insisting that adding a credit check along with the bank's credit team will be or more efficient in this, and not just blindly following sales. Coming to the current question which Pratik was asking me, I guess there has been a lot of shifts in the products as well as the company's overview. So currently it was term loans, ODs, and CCs, but banks have introduced a lot of new products which can be off the balance sheet and help you decorate your balance sheet or beautify your balance sheets and financial. In this era of IPO and I will say the credit rating, the everyone also have to see their other ratios as well. So summing it up, I will feel factoring now currently the all the new products in the market are very limited to the elite or I will say the high rating customers who have double A or A minus rating. So banks have sorry, the corporates have now shifted to not just simply CCOD but also beautifying their balance sheet with the different products in the market, like the trades platform, which is a great initiative by GOI of India. So I feel this is these are the new products in which they have shifted now. That's my take on this.
Thank you so much, Jayesh. Thank you so much, Amin. So, great point that, you need to keep your ratios favorable while, you take a lot of, bank ODs and CCs, you erode your ratios. And henceforth, it has become very important to, plan your finances smartly and, bring some supply chain options so that, off balance sheet loans can, help you keep your ratios good as well as, give you extra cash to do the sales. To Matthew and Piyush, will come to the credit risk portion. So, credit risk is often not taken seriously until it's too late, right? How has ignoring credit risk hurt manufacturing companies in your view? So, I'll come to Matthews first and then Piyush. Yeah, Matthews.
Right. Hi. Thanks, Piyush, Pradeep, for the question, and thank you for having me here. It's an honor to be here. Answering your question in terms of how credit risk can impact companies. I mean, so we at TAP see a lot of MSMEs, right? And one of the biggest risks that we try to understand from an MSME's point of view is their cash flow management, because you might be doing 100 CR in revenues, but if none of them is hitting your bank, then like it's an extremely big problem for you. So in terms of credit risk, honestly, if your uh, risk assessment of your clients isn't strong and your collections isn't strong, it not only does it block up your capital, it also blocks up so much of your time, because of course capital is blocked. You can't deploy that capital, you can't use that capital to leverage higher revenues. In fact, in very bad cases, we've actually seen companies go delinquent on accounts primarily because they simply did not have the cash flow to fulfill it. Their fundamentals were strong, but at that point in time when the payment came due, they couldn't pay because they didn't have the money at that point in time. So that is, of course, one very big one, and I think that's something that people understand relatively well at this point. And all of you have spoken about it at length as well. But another thing is it takes up so much of your time. You as somebody who runs a company, or as a finance person in a company, if you're dedicating half your day in collections, there's so many other things that you can perhaps do with that time that adds a lot of value to the company that you can't do. So if you nip this problem in the bud, not only does it free up your capital, it frees up your time to do a lot of more productive things. So in general, I think it's extremely important for companies to keep their credit risk in check, and the benefits of that accrue multifold, right? So yeah.
So, great point, actually, Matthew. No matter how much smart your team is, if your finances are not managed perfectly and you are at the hell of, credit risk, and your 100 crore may not return, actually, even if your production and sales team does very great, right? So, it is very important to have that thing in mind. So, Piyush, because, you are in the consulting background, and, you must have dealt with, innumerable credit checks, and you must have been doing a lot of credit checks for your clients as well. What is your perspective on this?
Well, first of all, good evening, everyone, and thank you, Prateek, for the warm introduction. And you have mostly covered all the points in your deck, but I will like to answer this by a practical approach. Like we had a client in Bangalore 2 years back. When I first met the CEO, what we observed in the books was most of the receivables were hovering between 90 to 120 days, and more than 50% of those AL were hovering between 90 to 120 days. And the worst case was the bad debts were 1% of the top line. So what we observed that uh, it basically wiped off 20% of your net profit. So what happens is it eats up 2 to 3 months of your business as a whole. One single company or two single companies, or just 4 to 5 invoices may eat up 2 to 3 months of your business. So it is a very tough task, but we have to start taking measures, use smarter tools for this, and this results in, as per your question, what happens when we ignore such points. First and foremost is the cash crunch. As everyone mentioned, cash crunch is the main thing. Even after we have sales booming, even after we have a lot of profits coming in, even after we have a lot of orders coming in, but if you're profit rich but cash poor, your business is not going to survive. So first of all, cash crunch is the main problem we deal with. Liquidity and working capital resources, that follows up. Second point is when we get delayed in payments, automatically our expenses rise, right? Automatically we have to service the debts if we are or use up our own money, which adds up to our opportunity cost as well. So again, third point like to mention is if we are not going to credit risk, we are not going to credit checks. Sometimes we go for overexposure to the clients, right? Overexposure means if a client, we can ask for the credit ratings or credit check. The particular credit limit has to be set at 50 lakhs, but we tend to overboard it and go and give a credit of 1 CR. Then the financial risks are much higher in those cases. So our money again gets stuck, and we get into a vicious cycle of this circle of low cash flows. So again, and bad debts, of course, directly hits your profit, and we have a lot of expenses. So that's the point, the 3 points here.
Thank you so much, Piyush. So, Piyush has brought up a very important point. When, your payments are delayed, you ultimately are incurring extra cost. We usually neglect those costs, but what happens is, like, if your 100 crores are delayed, you are incurring at least, even if it is delayed by, say, on an average 30 days, you are incurring at least, approximately 1 to 2 lakhs extra, right? On that. Sorry, 10 to 20 lakhs extra on that, right? So that is very important, because ultimately those are going up from your hard-earned money that is coming from your profits, right? Furthermore, any bad debts which you incur is ultimately burning up your profits in a huge way, right? 5 crore is a profit and 1% is bad debt. So, 20% of your profits going away. Thank you so much, Piyush. With this, we'll move to our next round of discussion. So, we spoke of how older ways were working, right? Now we'll shift to, what kind of newer ways have come in on the supply chain financing side, on the credit risk side, right? So, let's talk about the tools and strategies that are helping businesses today. I'll come first to Jayesh and Matthew. How are new age financing solutions like supply chain finance and WCDL instead of CCOD making growth faster for traditional companies? Yeah, Jayesh, please.
Yeah, hi Pratik. I feel that currently, which I was discussing before as well, the ratios have to be improved. So there is a need for more of a customized or a structured supply chain finance. This has been started by two or three financial institutions where they sit with the finance team and understand your balance sheet and see where the issue is there. So we cannot take care after the cash or something else, but we can take care of the debt, the leverage, the interest part, the fees and everything, and then they customize that supply chain finance product according to the need of your balance sheet. So that might attract a cost which can be 50 to 60 bips above than the normal financing. But that will help you a lot in the long run, because that will help you increase the credit rating, which in further will help you reduce your interest rates and all. And I will say currently government of India has made an allowed factoring backed by insurance, which I guess started in 2023 now by Tata AIG and HDFC Aero. That is, I think, the latest product of supply chain financing, the current book of which a BG backed finance, a BG or an insurance backed financing in the whole industry is, I guess, 5-6 thousand crores only. So this new product, I think, is the latest supply chain finance which everyone should tap on. Yes,
Sure,
ma'am.
sure. Matthew?
Right. So in terms of how supply chain financing can help companies, right? I mean, at the end of the day, what you're trying to accomplish through supply chain financing is improving your cash conversion cycle. So reduce your AR days, increase your AP days if you can, right? Very simple in that regard. And of course, there are multiple tools to do that. You, of course, have bill discounting, you have WCDLs, you have your traditional products like OTCC. As Jay said, there are insurance-backed factoring products as well in the market. So, of course, there are different products that are fit for different use cases. There are different products that are fit for different industries. For a retail industry, bill discounting might not make sense because you anyway get money upfront, right? So, multiple products, but all of them at the end of the day try to do the same thing: reduce AR, increase AP. And if you're able to do that, let's say you're somehow able to manage your cash conversion cycle to a point where it's in a negative cash conversion cycle, which means that you get money before you actually have to provide a service or a good, right? That frees up so much capital for you. Like all your working capital now you can use for growth. Now you can use for capex, right? So you can significantly ramp up your manufacturing capabilities. You can significantly ramp up your sales capabilities. You can significantly ramp up your backend capabilities. You can build a significantly more robust company as a whole if your working capital is sorted, right? Because working capital is the bottleneck that chokes most companies at the end of the day. And this is something I've seen a lot in the financing while working here, right? So if you manage your cash flows well, you will have money to deploy in other things and make your money work harder than you do, right? So yeah.
Correctly pointed out, Matthews, like, when we have a negative working capital cycle, say, you are doing 100 crores of sales and your current working capital involvement was approximately 8 to 10 crores. Now, when you have a shorter working capital cycle, you may not rotate it for 12 times, but rather 24, 36 times, right? I mean, with the use of same 8 to 10 crores of working capital balance, you can make, turnover of 200 crore rather instead of 100 crore or maybe 300 crore. So, you are doubling or tripling your profitability just by, efficient use of your working capital. Uh, uh, cool. Amit, so, from the perspective of, being a banker, we see a lot of, export import financing playing a vital role for the new age companies right now. And how are banks like HSBC helping this, helping them drive this challenge?
Yeah, so Pratik, I think great points put by all the panelists here. On the export import financing part, financing is one aspect, and The other is the ease of financing and the ease of the entire process flow. If you see from a client point of view, getting access to finance is hurdle one, which many good clients cross. But then the challenge comes in the overall management, the regularization of the bill, the general process overall tax, which are new for them. In HSBC, what we do for clients, being a premier global bank with presence of around 66 countries, our trade platform is very simple and it's very state of the art. Given we have refined it based on feedback from multiple clients, we give a clear process flow of the transaction, be it on the present status of it, on the forward or the forex rate booking. The entire journey leg is made seamless, which can be operated from the phone or the laptop of the person, and that is backed with an export financing options like packing credit, post shipment bill discounting, and uh, like with the basic pure vanilla options like these, we have also added the insurance or the TCI backed export financing along with this, which give a lot of freeway to the clients to then bid for more orders. If they have a customer in say a country X, where they don't have a clear visibility on the credit risk of that customer, the how the receivables will be in the long run, they can like knock on HSBC door, and HSBC can arrange an insurance for that particular customer, and so that then that client can go completely uh, with the order book of that particular client. So the ease of business, the overall tech platform which HSBC has designed, and the various layers of facilities, I think is what HSBC is doing for the entire ecosystem here.
Sure. So, I think, you mentioned it very correctly that, it is not just about, doing the financing, but rather also securing ourselves when we are doing international trade. Very good point. I mean, thank you so much. So Piyush, we have spoken enough for, what our customers need to do while securing themselves from the credit risk, right? How is credit risk being managed differently now? Like, what kind of things which people nowadays do? What are the smarter ways companies can protect themselves from, bad debts and defaults? What kind of things which they can do actually?
Well, Pratik, previously, what we used to do was we used to make credit decision as per our long-term relationships, and we used to more rely on our intuition that ये अच्छा करेगा ये अच्छा नहीं करेगा. We don't know exactly, but now we are more relying, we are in a transition mode to data driven results. We are more into analytics, we are more into using smarter tools. People are using underwriting services, so we are more into data-driven results. We are using analytics to and third-party services like Crystal or Dun Bradshaw, Sybil, whatever it is needed to get to a point that certain clients uh, are given a credit limit that we cannot exceed that credit limit, or they can reject the credit limit as per the credit ratings of the agencies and rely on several factors, not just one. So this is totally a data-driven process. Second thing is previously we used to also start with credit only and only credit ratings based on vendor onboarding only. Right now, what we are doing is we are doing real-time monitoring even after onboarding. We have to continuously check and recheck during several times during the year, or maybe once a year or once in 2 years. We have to periodically check the credit ratings and what kind of financial reviews are there for the vendors. Accordingly, we have to take the decisions, and this is very very important. And of course, there are several tools was mentioned by other panelists as well. The invoice factoring is invoice discounting is like the much needed tool in today's world, I guess. So it's basically transfers your risk to the bank and NBFCs. That's the best thing I think you can do. And tighter internal controls are basically that's the 4 point, I guess, will cover mostly everything. Yeah.
Sure. Thank you so much, Piyush. So basically, moving from traditional intuition-based decision making to more data driven decisions by using different tools. We take credit call, because this is how it used to happen, right? I mean, if you have a relationship with that particular customer, you used to believe him, right? But what happens is, like, after 2 3 years down the line, if you don't get into the data back decision, that customer is getting into insolvency, and you have ended up selling, say, 1 to 2 crores of products to him, right? And that customer was on the verge of being a insolvent person, and henceforth data driven decision is very important in that call. Sure. Thank you so much. So, with this, we'll move to the third part of our panel discussion. What exactly, we have discussed about, what are the problems, what kind of things which we can do. Now, we will see, exact point to point action points, how you should adapt, right? So, to Piyush and Jayesh, let's now focus on action. What our audience can take back with them with this entire discussion. Yeah, Piyush, please.
Yeah. First of all, I would like to mention that people has to have their credit underwriting process set up. There has to be an SOP for vendor onboarding. There has to be. These 2 points are the most important points we have to go take up while going forward to take the credit risk seriously. And like credit limit assignment, this has to be done for every party. Even if there are parties which have already in business with, you have to get a credit check and get their payment patterns, their behavior patterns, and accordingly set a credit limit to them. Assignment of credit limits is very, very important. And while vendor onboarding, like one of the participants also questioned that regarding 45 days payment, if they don't make payments in 45 days, we have to make an agreement detailing with payment terms, with penalties for overdues. These are very important points. We have to take care of these. If we follow these 3 or 4 points, that would be enough to get a good credit check in point. And SOPs are really important. That's the first and foremost thing.
Sure. Jayesh, your take?
Yeah, I guess I completely agree with Piyush. Laying SOPs and strategies and process is the most important thing of a planning part. And I would like to add more to this, though talking about risk, I think that it is the unsolved mystery where to stop a line and which customer to onboard and which to not. So because opportunity and risk go hand in hand. But one thing I feel good about your company and others are they started underwriting and everything. One thing I will say is that if you include some financial institution in your supply chain financing, their credit team will add more to your credit underwriting and all. And then talking about I think the main you can actually measure how things are going to go bad in future is by so let us talk about steel industry specifically. So it is currently being governed more by government consumptions and the budget which have been allocated to them. So you should like see every quarter they publish a report how much have we disbursed and is there a stoppage in flow or something. So beforehand you get to know that the stoppage is there and your receivables might get struck. So the person who makes the noise first will get the money, and the other ones might have to delay their working capital cycle. So a close note on the industry and talking about the collection part also. This is something we can do pre and after post this we can look at that the collection team should have a good relation with the customer, that there should not be any NPAs or just because we didn't do any underwriting. So I guess relationship building is also main part in this collection and saving your risk, I will say.
Sure. So, setting up SOPs, having a great underwriting team, and most importantly, having a informal relationship with the customers as well, help you sometimes take out your money faster. Cool. Thank you so much, Piyush Desh. To Amit and Matthew, so because you guys are mostly engaged into the financing side of it, which financing options are best suited for growing businesses today? Like, how can they use them to improve cash flow and fund utilization? Yeah, Matthew, you can go it first.
Right. So in terms of the products that are available in the market, right, as I said, multiple products exist for multiple use cases. You have your traditional ODCCs that most SMEs and MSMEs will use, especially if it's CGT SME backed. It's a lot easier for them to actually access that. Once you've tapped into that, you have bill discounting. Now, when it comes to bill discounting for smaller companies, less than 400 CR, not investment grade, it's a little difficult for them to access bank lines. So you go to NBFCs or you come to players like us, like Tap, right, where we can take calls. We will, of course, underwrite those SMEs, provide you with SID or PID, so sales invoice discounting or purchase invoice discounting. Then you have NBFCs that will give you WCDLs, which essentially act like 30-day loans, 30, 90-day, whatever day loans. Apart from that, you have import export financing again. Even if you're a small company, banks might not take a call, but there are n number of fintechs in the country that do it, right? So you have access to that as well. And of course, one of the easiest ways for smaller companies, MSMEs, to actually get access to better credit in terms of better rates is going through their anchors. So if they're selling to or buying from a significantly bigger party, again, a 400 CR company, 500 CR company, then using the credit worthiness of that company, they can access like credit lines. So that's your anchor vendor financing or dealer distributor financing. So there are multiple options that a company can tap into. Uh, of course, like what works best for somebody depends on their use case, but a lot of products in the market today that can help companies.
Sure. Amit, your take on it?
Yeah. So I think as like fairly pointed out by Matthew, there is no one size fits all approach here. We in the bank, we go for a more customized offering for each and every client based on their exact requirement. In terms of products, the pure vanilla overdraft CC, WCDL, these are definitely there. If we move on the non-fund based part, letter of credit or a bank guarantee is there. And now on the exact transactional receivable part and the payable part, we have a bill discounting kind of a product which can be structured with an insurance backed, without an insurance backed as well. If it's insurance backed, it becomes a limited recourse on the buyer, wherein that entire onus is on that TCI or the insurance provider. On the purchase side, we also do a product called loan against imports, which is nothing but very similar to a buyer's credit product, which used to happen earlier. In how HSBC is slightly different in this product is that we use the additional nostro surplus of our entire bouquet of clients who maintain the EFC with us. Whatever is the incremental EFC balances that we use and fund the other entities using that balances, which is the LAI product. We also use the Gift City for our funding. Gift City, which then arrange for funding. So apart from these, the subvention for export-oriented clients was something which greatly used to help the clients, which has been stopped post December. But we are seeing offshoots. It might come back again. So once it comes back, the pricing and a forward contract subvention based tracking rate will be the best option for a client. So there are multiple options, and it's completely dependent on the client how they want to proceed on it.
Thank you so much, Amit. So yeah, I mean, loan against import is, one product which is like a very good product of, bank wherein, you pay lesser interest actually, than the normal CCOD account while you do the import. So it not only just, gives you extra capital, but also, gives you capital at a lower rate of interest. Yep. Cool. Thank you so much, everyone. Gaurav.
Thank you, everyone. That was a great session. Thanks to our panelists. I think it was really insightful, and everyone over here will take something back with them today, right? We will now open this floor for question. Anyone having any questions to the panelists or to Pratik can drop them in the text in the chat and address the person who this question is for. I think we already have one question from Shresht earlier. Jayesh, if you can help Shresht with the product that we were discussing during the new age financing products, that would be helpful.
Yes, Gaurav. I will also mention it in the chat as well for him to better note things and explain it there. So, namely, some product which I discussed was the structured supply chain finance, which includes dynamic invoice discounting, or you can say customized dealer finance and a vendor finance model in which the OEM doesn't come into picture and you directly flow it to the other account, or a tier two financing. Currently, which has been recently launched, is the BG backed insurance, which is, I guess, done by only four partners, which is HDFC, Tata, IFCO, Tokyo, and one more. I'm not sure. So these are the some new age financing products which can be availed by obviously double A and A rated and above customers because of the, I will say, the check in the market. So if you have any counter question, Shresh, you can let me know on this.
Perfect. Thanks, Jayesh. Anyone else having any questions can raise their hands and drop them in the chat box, and we'll take them out. Shresht, we will check with the backend team and see if we can share this recording with the audience, or if we can upload that to our media centers. We will update you on this shortly. Perfect. I think this was really insightful, team. Thank you, Amit. Thank you, Jayesh. Thank you, Matthew, and thank you, Piyush, for your thoughts and insights. I think to everyone in the audience, what we have learned today is pretty simple, right? Managing credit risk well and using modern financing options can completely change the way your business grows. And that once and how we understand and how we implement it is the game changer that we are talking about over here, right? To add on further, at Now Purchase, right, we are building solutions to support this shift, right? From financing to supply chain to smarter buying, right? We aim to be the partner that helps traditional businesses become future ready. Because that's our motto, right? And I would again say thank you for being part of this discussion. It was really insightful. I hope you have something to take back today. And in case someone has any questions, okay, we have one questions from Mirza, that we will take it up. But in case someone has any questions or want to have a one-to-one sessions later, they can reach out to me at my email and the number that I'll be sharing soon in the chat box. In the meanwhile, what is the general consensus today for the debt leverage? Prateek, if you can direct this question to one of the panelists, that would be helpful.
I'll rather take it up. So, debt leverage is, previously we used to see that, we can have a 4:1 debt to equity ratio, right? I mean, but this has changed a lot. And, Amit, Amit, Jayesh, you can come in and, disagree to my thing or agree to my pointer here. So, people nowadays, they are, businesses nowadays are thought from a perspective that, how much margins you can earn. So basically, if say example, you are taking an extra debt, right? Now that debt, if you are putting in some working capital and getting some extra margins out of it, it is completely okay that if you are highly leveraged by your debt, and you are earning extra margin out of it, ultimately your EBITDA is going up, and your PAT is going up. So it doesn't matter how much leveraged you are in terms of debt. Of course, the bar is not set very high. Four is like maximum. Amit, if you have any pointer, Jayesh, if you have any pointer here.
Yeah, Pratik. So I think it's again a very customized scenario, like not one size fits all. We definitely it's not the be all and end all. We look at gearing, we look at the debt to net worth ratio, but liquidity, profitability, the growth of sales, the projections, these all play an important role. And also the another point on loans or the debt is whether it's unsecured in nature and whether it's from bank debt or not. If in case it's unsecured from friends and family, we can also classify it as quasi equity, which will stay for the tenure of the facility, which will help improve the overall net worth and reduce the gearing. So it's a very fluid thing.
I also completely agree with Amit that, but I guess that any unsecured loans given by the promoter family is already deducted from the debt ratio. And if we talk about many industries, so if you're in a manufacturing or a mining or some industry like this, your debt equity ratio will always be higher because you are using the debt to invest in some fixed assets which is used for the further business and all. And I think that is okay if you do it. But if you take a very classic example, I was there in Kolkata and I was sitting with Vedanta's flagship company ESL. The debt equity ratio, because of a manufacturing firm, they've reached something around 9 to 10 debt equity ratio. Even after an EBITDA of 560 crores, they're getting PAT negative because their finance cost is getting very high. So I feel there should be a balance of both the things. If you're a pure trader and a investment less industry, then I don't think so. Leverage should go anything above two, 2.5, or three. But if you are in a manufacturing, I think four is also. I will agree with Pratik here. Four is also an okay ratio if invested heavily in a fixed asset or something.
Sure. Thank you so much, Amit and Jesh. Thank you. Gaurav? Yeah.
Perfect. I think we are good to go, guys. Thank you so much again, and we hope to have similar sessions soon again. To maybe physical this time to address a larger audience later on. But again, thank you so much for having us over here, and thank you so much, guys.
Thanks. Thanks.
Thank you, Gaurav. Thank you,
Thanks,
Pradeep.
Pratik. Thanks, Gaurav.